Today, you'll discover an ETF that is distributing over 11% of dividends to their shareholders every single month. But I'll share with you why most investors should absolutely avoid this kind of ETF and why some of them might find a certain utility in investing in that kind of fund. So today, you'll find a full ETF analysis on the famous Hamilton Enhanced US Covered Call ETF with the ticker HYLD. But before to understand what this ETF is all about and what are the pros and the cons of holding it, let me introduce you to the covered call strategy. So a covered call strategy is when a fund manager of a certain ETF will decide to sell different call options of different companies that they own within this ETF. And so a call option is actually a contract between a buyer and a seller that the buyer will buy a certain company at a certain price that is fixed in advance. But usually, if the price of the underlying assets hasn't gained any value throughout the period of the contract, well, it means that the buyer of the call will let this option expire and will only have to pay the initial price to buy the option. So you can understand that when on your side you decide to buy a call option, it is because you anticipate some growth in the value of a certain company. However, the covered call strategy is a little bit different than that. Whereas when you decide, for example, to buy a call option, it means that you won't have initially the companies in which you have the option. Well, in the case of the covered call strategy, you'll already be owning the different company and the different stock. Plus, in that particular case, in their covered call strategy, this fund is actually selling call options. It means that by owning the stock, you'll be automatically protected and covered if the price of the company goes up because the options will simply expire. So a covered call strategy is a strategy that offers you some limited return but with some limited risk. By keeping that in mind, this kind of strategy can be very interesting for investors, for example, that want to counterbalance the high risk that comes with a portfolio full of growth stocks and ETFs. And in that case, this ETF would provide them more stability with more dividend income every single month for their portfolio. The Hamilton Enhanced US Covered Call ETF seeks to provide some excellent and some attractive monthly dividend income to their different shareholders by also giving great long-term capital appreciation by mainly focusing in covered call ETF that are focused on the US market. It is why among the biggest holdings of this fund, you can find great ETFs such as JP Morgan Nasdaq Equity Premium Equity, the JP Morgan Equity Premium Income, the Horizon US Large Cap Equity Covered Call ETF, and the Horizon's Nasdaq 100 Covered Call ETF, which are each worth about 20% of the total assets of this fund. So it means that only by those 4 ETFs, this represents about 80% of the total assets of this ETF, meaning that indirectly you'll find some of the greatest and of the largest American companies within this fund. In terms of the sectoral distribution, with no surprise, you can find the technology sector as the largest sector of the ETF, followed by the healthcare, the consumer discretionary, and the financials. Unfortunately, on your part, if you would have invested about $10,000 in that fund at its inception on the market at the beginning of 2022, well, it will be worth about $9,200 at the moment, which represents an average annual return of less 5%. Plus, with a super high MER of about 2.42%, you can expect to pay some annual management fees of about $242 per $10,000 invest. These higher fees obviously comes from the fact that when you decide to purchase an ETF that has different options in it, well, it obviously means that you'll have to pay higher fees, notably to different people that will have the obligation to manage the different fund and the different options that comes with it. And it is why on my part, I prefer to invest in great passively managed ETF, for example, VFV, that only have some small fees of about 0.09% per year, or only $9 of fees per $10,000 invest. But obviously, the big advantage of this Hamilton ETF is that it is giving over 11.50% of monthly dividend distributions to their different shareholders. And this actually represents over 10 times more dividend distribution that is giving to their different shareholders compared to the average S&P 500 ETF. However, previously, the dividend income distribution was even higher and it was cut recently in April 2023 to about 12 cents per month or a diminution of about 2 cents per month. Nevertheless, one of the other big pros of this ETF is that it will provide you less volatility in your overall portfolio, which obviously translates into less risk compared to the average ETF on the market. At the end of the day, when we take a look at the capital appreciation of this ETF since its inception on the market in 2022, we can see that it is currently down of more than 20%. So despite giving some excellent monthly dividend income distribution, I believe that this ETF isn't the best for the young investors that have a long-term horizon. Indeed, HYLD is quite expensive and it means that you'll have to sacrifice some potential return for some high income that you'll receive. So in my opinion, this fund shouldn't be considered before you come close to your retirement, where you'll be looking more for great stability in your cash flow compared to some capital appreciation. And at the same time, this kind of ETF will be very interesting for you at that time because it will also reduce your total risk in your portfolio. But over the long term, the fees that you'll have to pay combined with the limited potential are not worth it in my opinion, especially for young investors. However, if you find yourself in a position where you want to increase as much as possible your net worth over the long term, well, in that case, check out the video that's gonna be right over here and I will see you soon. Peace!